Hello and welcome to this week's economic update. My name is Lindy Pond and today is July 13th, 2023. I share this information each week with you guys so you can be informed to help you maximize your real estate investing. We're going to go ahead and get started with some comments the Fed made. So the Fed minutes from the June 14th meeting showed plans to hike rates more this year and to keep rates higher for longer. Most Fed members agree on 2 more hikes, which would bring the Fed fund rate to 5.5 to 5.75%. The economy is showing signs of slowing down. Fed members talked about continuing to hike, even though the economy is showing signs of slowing down. Remember, the Fed wants to get inflation down to 2%. Housing, Dallas Fed member Lori Logan said the housing market has likely bottomed out and a move higher in home prices is an upside risk to inflation. Not so great for us, but good for inflation. Recession. Most are still predicting a mild recession by year end. We're going to take a look at employment or unemployment. So the ADP employment report, ADP released their employment report showing 497,000 job creations in June. This was double estimates. Leisure and hospitality still leading the pack with gains of 373,000, and construction, like we talked about last week, was 97,000. Job stayers increased pay just a little bit from 6.4 down from 6.6, and then job changers increased a little bit, 11.2 down from 12.1. Wage continues to slow for the 12th months in a row. So we're still increasing on income, but it's slow. The increases are getting smaller and smaller. I guess that's a way to say it. So we're slowing down on our increases, even though they are still increases. The BLS, or the Bureau of Labor Statistics, remember there's 2 surveys. One is the business survey that comes from modeling and estimations. This is where we get the headline job creations number you hear about in the media. And then there's the household survey where they actually get data and information from calling households. I have yet to be one of those called. This is where we get the unemployment figure. So in the business survey, we increased jobs 209,000 versus the 240 expected, so kind of in line. And then the household survey increased 273,000. What's interesting is on the unemployment, remember the unemployment rate comes from the previous slide, the BLS household survey by calling households. The U3 unemployment rate decreased from 3.7 to 3.6, not a big number. The U6 all-in rate, though, the unemployment rate increased from 6.7 to 6.9. This all-in rate includes people actively and not actively looking for a job. So people who were actively looking and then stopped, and then people who were still actively looking. What I thought was super interesting was we gained 233 people, multiple job holders was up 233,000, could only find part-time was up 122,000, and then part-time for economic reasons was up 452,000. So you got to wonder how many full-time jobs did we lose if people are, if the unemployment rate still increased, so there's more people out of work, yet part-time for economic reasons was up 452, so part-timers, right? So how many full-time jobs did we lose for those numbers to all work out? The average hourly earnings were up only 0.4% in May. The average weekly hours worked fell a little tiny bit, and the average weekly earnings were up 0.7%, so not a whole lot of movement there. Heard on the streets for the week, housing bottomed in December, proving to be very resilient in the current economic troubles. Economic policy is not able to impact housing. Keep that in mind. CoreLogic reported home prices rose 0.9% in May after rising 1.2% in April, now up 1.4% year over year. Home prices are expected or projected to rise another 4.5% over the next 12 months. This equates to about 10% in all of 2023. Black Knight is not as aggressive, and they agree, but show a slower increase of 5%. So if you're listening to CoreLogic or Black Knight, home prices will rise 5 to 10% sometime over the course of 2023. The CoreLogic home equity report for Q1 showed that home equity dropped by just a little bit, 0.7%, but it is due to a large amount of people doing cash out refinances. A lot of people with low interest rates are going to stay put, and staying put means remodeling their kitchen or their bath or adding on an extra bedroom, right? The chief economist from ADP, Nella Richardson, she says, quote, consumer-facing service industries, leisure and hospitality, had a strong June, aligning to push job creation higher than expected. But wage growth continues to ebb in these same industries, and hiring likely is cresting after a late cycle surge. So again, not so positive on the employment outlook. Our mortgage data for the week, weekly conventional mortgage rates are up again this week. We went from 6.875 last week to 7% this week. Remember, that is conventional mortgages, so DSCR long-term 30-year fixed investor loans are anywhere from 1% to 1.5% higher. That puts us in that 7 to 10% range, depending on your credit, LTV, and the DSCR calculation. As always, remember, if I can help you with any of your financing needs, please give me a call. You'll notice I added our new Bridge Flex, which is a 30-year fixed rate or interest only. The benefit of it is it's a long-term DSCR loan with no prepayment penalty. So if there's anything I can do to help you out there, you just let me know. Thank you.